Welcome to Subramani. I'm going to talk to you about value investing and say why value investing works. I've been a very long investor for a very long time. I would say a long investor and a long time. And I believe that a portion of my portfolio is value investing and a portion of my portfolio is growth investing. And I don't get too much into whether I should do this, what percentage and all that. But I wanted to just clarify why value investing works. So let us talk of bonds first. It is easier to value bonds than to value, say, equity. So let us take the case of two value investors both wanting to buy bonds. There are two bonds issued by the same group company with the same maturity of, let's say, 25 years, right? Both companies have issued, two companies in the same group have issued bonds. You are comfortable with the group, and so is your friend, right? Two people, let's call them A and B. A goes and subscribes to the bond at let's say 1000 rupees. He buys 20 bonds at 1000 rupees. He has put 20,000 rupees. And he on 20,000 rupees he has to get 5% return, so he will get, let's say the 5% is a coupon, so he will get 1000 rupees and he is happy with that 1000 rupees. Now the other friend, let's say B is waiting for some time. He finds some Hindenburg report hitting the company, and the same bond is available at 800 rupees. So he also goes and puts 20,000 rupees into it, and so obviously he gets more number of bonds. The first guy got 20 bonds, the second fellow gets 25 bonds. It's as simple as that. So on a 1000 rupee bond, both get 5%, so that is 50 rupees. So the first person gets 50 into 50 into 20, he gets 1000. The second person gets 50 into 25, that is 1250, right? So the second investor is getting 250 rupees more per month for the next whatever is a decade, or 20 years or 25 years, which is the life of the bond. So please understand, he has already made money in that, right? So that is the advantage that he has got. Now fairly obvious, towards the end of the bond life, let's say 20 years later, the person who has invested at 800 rupees will also get 1000, and the first person who has invested at par with the company will also get 1000. Now here comes the crux. Now people will tell you that value investing is no longer working, it is only growth investing which is working. But let us understand one thing: the minute the person bought the bond at 800 rupees, and assuming that nothing else goes wrong, you're not worried about market fluctuations, you're going to hold the bond to maturity, the day you bought it at 800 rupees, you've already done your sensible value investing. It is over. Obviously, we will all wait for the day when we can redeem it at par and make that extra money, which is another 20%, which is the discount at which you got. So that extra 200 rupees per bond, which is going to make on 25 bonds, so that extra 5000 rupees. But that is incidental. I don't really care whether I make that or no. So let me give you an example from equity investing. I'll tell you a real life example. I bought Coal India at 119 and 117 rupees simply because I thought the dividend yield of 10%, 12% was good. Effectively, I am getting about 20% dividend yield, right? So having bought Coal India at 119, I have to make sure that it does not, okay, I'm getting a 20% yield. So even assuming 10 years later, I am able to sell it at 119 rupees, which is my cost. I'm still making that 20% return year on year, and my expectation from equity is only 12, right? So I'm getting an 8% extra alpha from my expectations. I'm not interested in knowing how much equity funds give, how much the Sensex gives. I'm not bothered. I want 12 on my equity. I'm getting 20, which means I'm getting 8% extra. Now, when somebody tells you that, oh, Coal India prices will not go up because of ESG and this, and FIIs won't buy, to me it does not matter. As long as Coal India pays me the 20% dividend yield, which I am getting because of my lower cost, my denominator is very low, I will make money. Now, fairly obvious. If I am able to sell it at 320, then I am making that extra 200 rupees per share, right? That extra money also I am making. But the minute I bought it at a 20% dividend yield, I am sure that I am not going to lose money, and I am going to get a 20% dividend yield, or actually the dividends have gone up now, so maybe but this is a post-COVID purchase, so it's fairly obvious that I have got fantastic dividend yields. Same thing for Vedanta. So I believe that if I got Indian Oil at 77 rupees, I've got Coal India at 119 rupees, and I've got Vedanta at 79 rupees. To me, these are good dividend yield shares which I have bought at that price. I'm not recommending, I'm only giving an example. Now, will value investing work? Will growth investing work? The unloved share at some price will find some Naren, Prashant Jain, somebody coming and buying in huge quantities, and then somebody else copying them, and therefore a Coal India could go to 330 and Indian Oil could go to 130. There is super value capture when if I sell off Indian Oil at 130 and Coal India at 330. But even without that value capture, I am still very well off simply because of the dividend yield. So let me just explain. Let us talk of a company which has got, say, 1000 crores in sales, 100 crores in profit, and it pays out 30% or 30 rupees 30 crores as dividend payout, right? Let's say it has got a 60 crore share capital. Now, there is somebody who buys it at a 30 PE and somebody who buys it at 15 PE. So, fairly obvious, the price of the share is 50 rupees. So, guy goes and puts 2 lakhs by paying 4,000, by buying 4,000 shares. And he gets rupees 2,000 as dividend, whereas the person who buys the same share at a PE of 15, he is buying now at a low, he is paying rupees 25 per share at half the price. He is also putting 2 lakhs of rupees and he is getting 8,000 shares, which means he is getting 4,000 per year as a dividend. So what is very, very important in value investing is you have to make sure that your value investing is not a value trap. So the most important thing in value investing, let me repeat, is you should not get into a value trap and the price should not fall below a particular level. So if I had bought let's say a Coal India at 119 and the price fell to 105 and I have to sell at that price, then I could be making a loss. I have to ensure only one thing. I have to ensure that the price does not fall when I want to sell it, and I may not want to sell it for 2 years, 3 years, 5 years, 10 years, and as long as I am getting the dividend yield, I really don't even care about the sale price, right? I am getting a 20% dividend yield. So two things which are important in value investing, especially if you are buying a dividend based investing share: the price should not fall from where you have bought when you want to sell it. I am okay if the price falls from 120 for Coal India to 100 and then the price goes back to above 120, which is my cost. It should not go below my cost. I should not make a capital loss while selling it, and I have a longish holding period. I can hold it for 20 years, so I don't have that problem. And secondly, the dividend should not go down, right? The company should not go down in terms of dividend. The dividend yield should not go below 20. And in fact, actually, even there I have a cushion of 8% because I am expecting only 12. So even if the share price were to fall, and or if the share price was to rise and I was wanting to put more money, I would still put more money in Coal India. In fact, I have bought Coal India at 120 and at 203, because even at 203 I said, okay, 10% dividend yield, what can go wrong? Yes, of course, our coal dependence can go wrong. 25 years we will run out of coal. We may be using more solar and wind and all that. All that is hogwash as of today. The question is it a good value investing at the price at which I bought it? Yes. Why didn't more number of people buy it? I have no clue. When I bought Tata Power at 30 rupees, believe me, Tata Power at 30 rupees, and I sold it at 260 rupees because somewhere I thought the full value has been captured. Then I bought it again at 210 or 212 rupees, and the price is there. So the advantage in buying some of these shares at those prices is you are assured of your correctness of buying a dividend yield. I mean, Tata Power had a 5% dividend yield. So here was a Tata Group company, which was the share was not had just been removed from A Group, but still it is a good quality share. It was in the MSCI index. And it was giving 5% dividend yield, and I was very sure that it would increase in value. Did I think it will go to 260 within 1.5 years of my buying, or even less than that? No, I didn't expect. But the fact that it went up got me an exit at that price, but that was incidental. I would have been very happy holding Tata Power going to 60 rupees. I would have held it for the rest of my life anyway. Right, so some portion I sold, some I bought back, but original what I bought at 30 rupees, a lot of it is still staying on in my portfolio. So if you are a good value investor and you are willing to wait, and you are saying, okay, this is the dividend yield, this company will not reduce the dividend yield, which is a guess, and at this price I am a buyer, immaterial of whether the market captures the upside. Of course, the market will have to capture the upside. Market is a slave of PE and EPS. So there will be some value investor, whether it is whether his name is called Naren or whether his name is Prashant Jain, it doesn't really matter. Somebody will pick up that share, and that share will do well, and you will be rewarded. But this perhaps I'm repeating, maybe for the third time I'm saying this, it does not matter if the market does not capture. You have to look at two things. Will the price fall below this? If the price falls below this, will you have the money to buy more, or will the dividend go down? These are the only two questions. The minute the dividend is slashed or the price falls, you just exit, because your whole calculation goes for a toss. So if I bought some share at 12% dividend yield and the price falls, and I'm afraid that there will be a capital loss and that my 12% is under threat, I'll sell. But if the price goes up, I know my 12% is protected. I can just ride the upside of it. So if Coal India were to go to 330, I may sell. I'm not even saying I won't sell, but I know one thing: at a 10% dividend yield and increasing dividend, making it look like a 20% dividend yield, my downside is completely protected. So if you are a value investor, you have to just make sure that you don't touch balls outside the off stump. Nothing else matters. Thank you.